Okay, last on the list then, CitiGroup. They're the one of these that I currently own. I'm thinking about quite a few of them, to be honest, and I think they look kind of nice. But their revenues for Q4 were 18 billion. Their net income, or earnings per share, was $1.16. Their dividend is staying flat. They're in the process of attempting to turn themselves around, basically, because what they do is four things. They have an institutional clients division, which generates about 54% of revenue, a personal banking and wealth management thing, which is to say US consumer stuff, and wealth management, which is 32%. Then they have these things called legacy franchises, which are a bunch of consumer operations in Australia, Bahrain, China, Indonesia, Malaysia, Philippines, Poland, Russia, South Korea, Taiwan, Thailand, Turkey, Vietnam and Mexico. They also do small business stuff in Mexico that they're in the process of getting rid of. The main reason being those are expensive to maintain and they don't have any obvious synergies with anything else that CitiGroup does. So they're kind of satellite things. They made, I think, pretty much nothing in net income on those things this quarter. And they've got buyers lined up for all of them. They've sold about 5 of them, or completed sales for about 5 of them. And their plan is basically to get their money out of that because that's very low margin stuff and it very much doesn't plug into anything else. Like last week when I was talking about Bank of America trying to build out areas where it has a card presence and convert people onto current accounts and savings accounts and mortgages and so on. CitiGroup basically does none of that with its consumer banking arm here. So what you have is some pretty low margin stuff there, which is an 8% operating margin as I see it, 37% in institutional clients and 33% in personal banking and wealth management. So those legacy franchises are dragging things. Their hope is to try and reinvest it elsewhere and start driving returns a little bit higher, basically. So that's pretty much CitiGroup. They're in the middle of a turnaround. I'm not sticking too much into what they reported this time out. They did the usual stuff, better on net interest income, worse on investment banking on absolutely creamed. Their fixed income, so bond trading desk did very well. Their equities trading desk did less well. Pretty much only stuff we've already said, apart from their distinctive structure, leaving them, I think, at a disadvantage to most of their competitors. Steve?
Yeah, Citibank looked really, really strong. I'm glad to see the back of the legacy franchises. I didn't get that far in the reports, to be honest. I didn't realise there was this much of it was actually going. It's been crappy margin stuff for a really long time, and it's been really difficult to understand why they were hanging on to it. It was one of the reasons when I did have Citibank, I was really worried about why they were hanging on to this 8% margin. Busy fools kind of work when the margins outside of that are so good. So it is good to see the back of that. I would expect that they'll get quite a large amount of money from these sales, and I would assume they'll invest some of it into themselves and some of it into their stock. I would assume you'll see a healthy buyback coming up, perhaps maybe a special dividend or something like that, which will be nice to reward Citibank shareholders, because it's been a tricky kind of ride for the last 4 and 5 years for them. They've had their issues because they have a large link to consumer debt. Obviously, when COVID came around and the world stopped, everybody was very, very worried about consumer debt, and Citibank were at the front of CityLink. Citibank were at the forefront of that, so they had a pretty hefty drop. But it is good to see Citibank back. They look very healthy, they're doing very well, and I think that was probably a good purchase of yours, Steve.
Thanks. And when they're not doing that, they enjoy trying to turn themselves into Wells Fargo by randomly wiring money to the wrong amount of money, to the right people, Revlon creditors. They finally settled that lately, which is why that's at the front of my mind. So that's probably out the way, although they need better internal controls to avoid accidentally crashing markets by pressing the wrong buttons or whatever their latest thing was. Yeah, on the subject of the sales, they've said, not in the most recent earnings call, but in historic ones, the stock trades at about half its book value, so there may well be scope for buybacks there. But their main plan is to try and redeploy that in places where they see better or higher margin opportunities, or higher return opportunities, I guess I should say. They're keeping their corporate or business operations in most of these countries. One of the things that Citibank does do that provides some value to its customers is their big global presence makes them useful for people doing business internationally. You can run that through Citibank in various places. That doesn't tend to be the case that there's much value for that with consumers. So who the hell cares about your current account in Vietnam and needing another one in Taiwan or something like that? So there's less interest on that, but they are hanging on to their wealth management operations and some of the stuff that is kind of higher value for them.